Hey, what's up, guys? You got Curtis here with Long Trend. Today we're going to take a look at Home Depot. We're going to look at their revenue, we're going to look at their cash flow, and then we're going to calculate an expected return to the shareholder by buying the stock today and holding it for the long term. So I hope you're ready. Stick with me and let's get into Home Depot. Okay, so I've got the Home Depot web model in front of me. And this is the number I'm interested in. So this is the internal rate of return. This is the implied return I'm going to get if I bought Home Depot today. So Home Depot right now is a $367 stock, and it's got a $386 billion market cap. So that's the stock price times the shares outstanding. And then what I'm interested in as an investor is I'm interested in the enterprise value of the business. Why am I interested in that? Because I want to look at the total business as an enterprise and understand its growth. And I don't want to muddy that growth number with any change in shares outstanding, which is what happens when you look at an earnings per share number. Sometimes companies will actually go into the market, issue debt, use the proceeds of that debt to go and buy back their own stock. And what happens then is their share count goes down, and therefore their earnings per share goes up, but there actually hasn't been any substance to that earnings per share growth other than just a financial transaction, a recapitalization of their balance sheet by replacing the equity in the business with debt in the business. Enterprise value for Home Depot, $424 billion. It's a big company and it's trading at 17.6 times enterprise value to EBITDA. That's a high valuation for Home Depot. Historically, it's been at 13 times. The nice thing about Home Depot, though, is they do have room to expand their balance sheet with debt if they wanted to. They're only at 1.3 times net debt to EBITDA, so they can go up to 3 times or 3.5 times before the bankers and the like will start to be interested. Okay, so moving into operating assumptions, I'm going to change this forecast. So what I'm going to do is I'm actually going to go to Yahoo Finance. Yahoo Finance publishes analyst estimates. So I'm going to pick up those analyst estimates for the first 2 years anyways, and that's always a good start for any model. And then we can flex the long term. You know, there's 31 analysts for Home Depot, and the average estimate for next year is 145. So I'm going to take that number, I'm going to plug it in. Go back here, and I'm going to say, okay, so this has to be 145, so I'm going to make that 1% growth next year. Close enough. And then the following year is 148. Okay, so this is a bit high, so I'm going to make that 1% again. Thereafter, I'm going to say that Home Depot returns to a 5% growth rate and then maybe 3% over time, which makes sense and is conservative for Home Depot. Historically, they've been at a 7% growth rate. And if I go over to the charts, I can see that revenue forecast looks okay to me. They've roughly doubled their revenue from $70 billion to $132 over a 10-year period. And then I'm not expecting it to double again. But what I would say is there is the market opportunity to do that. This is the 2019 investor deck from Home Depot. You know, Home Depot has the total U.S. market alone at a $650 billion opportunity. And they're suggesting that they've only captured 15% of that overall market. So I think that there's room for Home Depot to continue to grow. And a $200 billion revenue company in 10 years doesn't seem unreasonable to me. Maybe it's low, in fact. Okay, next chart. Home Depot has a 16% EBITDA margin, and they've done a good job of increasing that over time, and it's been held flat over the last 3 years, so I'm gonna carry that forward. That makes sense to me. Home Depot as a free cash flow generator has also been quite good. So they grew their free cash from $5 billion to $10 billion. In COVID, they did $16 billion, and if we take those analyst estimates of $145, next few years we're gonna do $15 billion, and we'll grow up to $20 billion over time. So not bad, and certainly a lot of cash that this company generates. Okay, so I'm going to flip back to the model. For the dividend over a 10-year period, Home Depot is probably not going to be able to continue to grow it at the rate that they have in the past. So they've been growing their dividend at 20% a year. Eventually, if you grow your dividend at such a fast rate, if your free cash flow doesn't grow at the same rate, your dividend coverage deteriorates. That's happened with Home Depot. But right now, the dividend is very safe. What I'm going to do for Home Depot is I'm going to say that their dividend growth rate is not 19% going forward. I'm going to use the 10% growth rate. For share repurchases, Home Depot has been buying back about $6 billion of stock. I'm going to leave that as a good number. I think that they can afford it. And with this forecast, it looks like Home Depot is funded to do that, right? So $15 billion of free cash flow, of which they're going to pay $7 billion in dividends, assuming a 10% growth rate, $6 billion in share repurchases. I actually also have a number here for acquisitions. So Home Depot has been a bit acquisitive over time, not very much so, but I do have a number in there that says there's a little bit of money to allow for acquisitions. And if they have been acquisitive and they've been growing, it's good to leave the acquisition numbers in there because often those acquisitions are what drives the growth for a company. Okay, so what does that all mean for an expected return? Well, you can go and buy the stock today for $366. You're going to get a dividend that's going to grow at 10% over time. And then if this all comes true, Home Depot will be a $500 stock in 10 years. So not a massive amount of capital appreciation. A lot of the return will be in the dividend, actually, of Home Depot. Now, for the 5.7% return that I'm calculating based on that cash flow stream, I'm going to call that the downside return. Here's why. I think I'm using a conservative growth forecast. Historically, they've been at 7%, and in the 2019 investor deck, we saw that there's a $650 billion opportunity. So I'm going to start with that 5.7%. I'm actually going to calculate an upside, and I'm going to call that the downside. And the upside is going to be if I return this back, let's say, to a more normal rate, which would be 6.9%. And if Home Depot is still growing at 7% in 10 years' time, maybe we give them a bit of a higher multiple as well. Let's say they only drop down to 15. So there you go. So 7.3% I think is their upside. Okay, so there you have it for Home Depot, folks. 7.3% return with a 5% downside is not bad in this market. Home Depot is more expensive than it has been historically, but it's also got some growth that you can model, which is going to help overall shareholder return. So you're going to get the dividend, you're going to get some capital appreciation with Home Depot, and it's a very high quality name as well. Okay, thanks, and I'll see you in the next one.